Since there's so much talk about whether AI is in a bubble, and so many investors hold S&P 500 funds like VU and SPY, I set out to answer three questions. How exposed is the S&P 500 to AI? Which parts of the S&P 500 are the most and least exposed? And how can you avoid exposure to the AI bubble and still outperform the S&P 500? The last one comes from one of the 600 plus members in our free Discord, by the way. So let's dive in. To answer the first question, how exposed is the S&P 500 to AI? I started with the Bloomberg AI Value Chain Index, which, long story short, is the index that I think best represents the AI ecosystem. There's also an ETF that has tracked it for just over a year with the ticker AIVC. Basically, this index takes the top 15 companies, as defined by Bloomberg's research, in three foundational areas of the AI ecosystem: semiconductors, cloud/software, and hardware. Those 45 companies are equally weighted in the index and periodically rebalanced to get back to even. The simplest way to answer what percentage of the S&P 500 is exposed to AI would probably just be to look at what percentage of the S&P 500 these companies represent, but of course, these are not the only companies that are impacted by AI. One of the key challenges in this project is that lots of companies have links to AI in one way or another. A bunch of the utility stocks are massively up on expectations of increased power demand, for example. And a similar theme is driving makers of gas turbines and electrical equipment. The data center building boom is also driving the stock prices of some of the building products companies, and construction and specialty manufacturers, and communications equipment, and nuclear companies, and energy storage, and specialty chemicals. The list is long. You get the idea. And of course, some companies are fully exposed, some companies are partially exposed, and then, of course, there are the indirect links, too, to complicate things even further. Not everybody who's excited about AI buys an AI-specific ETF. In fact, very few people do that. There are way more people who would buy something like a NASDAQ ETF like QQQ. Now, I don't think Costco or Pepsi or T-Mobile are AI stocks, but they are part of QQQ. And if someone buys QQQ or SPY or VU for that matter, because they're excited about AI, that boosts all of the company stock prices in that index or index fund, and vice versa. If they sell those ETFs because the AI bubble is bursting, then that hurts all of those stocks. So if you really think about it, the whole S&P 500 has some exposure to AI, either direct or indirect. But I wanted to see if I could get more specific to identify the portion that's highly exposed and where that comes from. So here's how I did it. I started with the Bloomberg AI index that I mentioned earlier, and I went back a year, which is about as far as I could go given the limited data available. The first step was to compare the daily returns of AI, this AI index, to the S&P 500 and look at how much AI won or lost by each day compared to the S&P 500. Then I took the daily returns of every company in this S&P 500 and I looked at how much they beat or trailed the S&P 500 by each day. Then step 3 was to run the correlation of each stock's daily outperformance and underperformance versus the S&P 500 to AIs. Or in simpler terms, were these companies beating the S&P 500 at the same time as the AI index was beating the S&P 500, or were they doing the opposite? Or did it seem like AI wasn't really an important factor either way? What I found was really interesting. Companies with high correlation to AI like Nvidia and Broadcom made up about 38% of the S&P 500. That's about what I expected. But companies with negative correlation to AI, meaning they usually beat the S&P on AI's bad days and they trailed the S&P 500 on AI's good days, actually made up almost 45% of the S&P 500. What's not surprising, though, is that while AI-related companies only make up about 38% of the S&P, they've accounted for more than 100% of the S&P 500's return over the past year, meaning the other 62% of companies, on balance, were actually down. Before we get to our second question, which areas of the S&P are most and least exposed to AI, some of which are likely to surprise you, one thing that constantly surprises me is that over 70% of you who watch this channel regularly still haven't yet subscribed to it. So, could I ask you for a quick favor before we continue? If you like this channel and you're getting value out of it and you want to support us, the free and easy way to do that, it would have a massive impact on our lives and cost you nothing, is by simply hitting that subscribe button. And my commitment to you is that if you do that, my partner Cal and I will do everything in our power to help you significantly improve your life by becoming a better investor. That's what we're here for. So thank you so much for being here. Now, to answer our second question, which areas of the S&P 500 are most and least exposed to AI? I broke down the highly correlated and negatively correlated companies by sector. No surprise, technology companies were the most exposed. What may surprise some people is how many technology companies were negatively correlated with AI. This is a bit misleading because almost that entire orange bar is Apple, which makes up 6.9% of the S&P 500, and all tech companies combined that had negative correlation to AI made up about 7.6% of the S&P. So it was mostly just Apple, but some IT services companies and software companies that are seen as potentially being disrupted by AI also made that category. Apple is generally considered by the market to be an AI loser, even though it's part of the Magnificent Seven. I'm not sure I agree with that notion, by the way, but they haven't really spent like drunken sailors on AI like a lot of other big tech companies have, which is why they've tended to do worse than the market when AI hype has been high and better than the S&P when AI hype has been dying down. The other areas with heavy exposure are communication services, which includes companies like Alphabet and Meta, and consumer discretionary, which includes companies like Amazon and Tesla. Broadly, these three sectors are what make up a lot of the quote growth style universe, meaning companies that are expected to grow faster but might be a little bit more expensive than the broader market. If we look at the iShares Russell 1000 Growth ETF, ticker IWF, they make up more than 77% of it. In the NASDAQ, aka QQQ, they make up over 86% of the index. So if you have exposure to these ETFs or similar ones, you have a lot of exposure to AI. The areas with the least exposure to AI, or put differently, the most exposure to things that tend to zig when AI zags, are healthcare, consumer staples, and financials. Energy and materials are there too, but if I imagine a scenario where the data center spending comes down and the AI bubble pops, I'm not sure those would do well. Energy and materials are what's known as cyclical sectors. They tend to do well when the economy is in an upcycle and tend to do poorly when it's in a down cycle. So while their businesses don't necessarily have much to do with AI directly, they do have a lot to do with the strength of the economy. And the AI data center boom has been propping up the entire economy. So that brings us back to areas like healthcare, financials, and consumer staples. You'll typically get a lot of exposure to these areas in value and dividend oriented ETFs, though not usually as concentrated as 70 plus percent like some of the options on the growth side. I won't spend too much time on healthcare since we just did a video about it last month. But yes, for the record, I still think healthcare is a really interesting opportunity because it's one of the few attractively valued areas of the market compared to its history. Most of the market's worst fears about healthcare, like tariffs and the most favored nation drug pricing, are behind us, and biotech stocks in particular, which is one of the areas of healthcare, could actually be a major long-term winner from AI that's totally underappreciated right now by the market. So that was the main focus of this video. Financials are a bit of a gray area. They have the most negatively correlated companies, since most banks are conservative, boring, and don't have much to do with AI. But they are somewhat cyclical, like energy and materials companies. Some financials are positively correlated with AI, like Robinhood, Coinbase, and some alternative asset managers. And most importantly, what really makes this a gray area is that I think some banks and insurance companies have more AI exposure than the market currently realizes. For example, there's been a big uptick in private credit, meaning non-banks lending money to private companies. A lot of the firms doing this private credit lending are also in the private equity business too, which means buying stakes in private companies. So they're lending them money and they're also buying stakes in them. There are two important pieces here that we need to put together. One, since AI has been so hot these last few years, a lot of the private funding, both on the equity side and the credit side, has been going to AI-related startups, In fact, over 50% by some accounts. The second piece is that since banks' main business is lending, and a lot of these companies are going elsewhere to borrow money, not to the banks have just been lending money to the private equity and private credit companies. So it doesn't look like the banks are lending a lot of money to AI startups. But in reality, banks are lending money to the private equity companies, and then the private equity companies are lending money to the AI startups. The added bonus for the banks is that private equity companies are seen as much less risky than the AI startups. So the banks don't have to hold as much safe money on their balance sheet to protect against potential losses. This is fairly similar to what was going on in the mortgage crisis leading up to 2008, where banks didn't realize how much exposure they had and thought that their lending was a lot higher quality than it really was. Now, I don't know if it's as much of their lending as it was back then. My guess is not. But long story short, it does muddy the waters a bit on whether financials are actually an area you can count on to limit your exposure to AI. I'm not so sure. And that brings us to consumer staples. This is an area that I've actually been buying recently and may add to again soon. These companies are really unloved right now, which is a nice way to put it, because consumers, particularly low end consumers that buy a lot of consumer staples, have been struggling with tariff driven price hikes, a weak jobs market, and there really hasn't been much growth in the economy anywhere outside of AI related areas. You can see from those three dotted lines, XLP, the iShares Consumer Staples ETF, is now about one standard deviation cheaper than its 10-year average. That means that it's only been cheaper than that about 16% of the time. Contrast that with the broader S&P 500, and that's about 1.5 standard deviations more expensive than its long-term average, long-term meaning the last 10 years. The divergence since mid-2024 has been extreme. It's actually not that uncommon if we go back a little bit for consumer staples to trade at a higher valuation than the S&P 500 overall, despite their lower growth, because stability is valuable, particularly in downturns. And we can see why if we compare their returns during the market downturn in 2022. The S&P was way ahead during the tech rally of 2020 and 2021, but then it fell in 2022 while consumer staples were flat or even slightly rising. So that brings us to the third question. How can you limit exposure to the AI bubble and beat the market? Well, I already mentioned you really can't completely avoid AI if you're invested in equities of any kind. And of course, there's no way to guarantee you'll beat the market. But here are three ideas of areas that I find attractive that have limited exposure to AI and, in my opinion, are likely to beat the S&P 500 over the next few years. Of course, as long as AI keeps driving the markets, none of these areas are very likely to beat the S&P. And I can't predict precisely when that's going to end, but I am highly confident that it is going to end at some point. And the best part is that that's not really required to get a good return out of any of these areas. It's just required to get a bad return from the S&P 500. So, in a relative sense, it would help these three areas beat the S&P. You could probably guess the first two since we've already talked about them. First is healthcare, which we recently covered in this video. Second is consumer staples, which I just covered over the last few minutes. Within consumer staples, I think there are two options. Obviously, there are more than two options, but I'm going to give you two here. For stability, I think something like XLP is a fine option. But if you're more in the camp of these are cheap, underappreciated, and ripe for a rebound, like I am, you could consider something like UGE, the ProShares Ultra Staples ETF with 2x leverage. That's what I recently took a small starter position in, and I might add to it again soon. Besides the valuations and the fact that utilities are often defensive in a downturn, I think that there's also a reasonable chance that at some point in the next few months, Trump's IEEPA tariff powers will be overturned by the Supreme Court. If that happens, a lot of these massive tariffs he's put on most of the world will go away. And that should help the profit margins of low margin companies that import a lot of stuff, like consumer staples companies, while also boosting the purchasing power of the low end consumer. I think that would be a big win for staples if it happened. The third area of opportunity that we haven't talked about yet today is international. Now, you're not completely avoiding AI exposure there either, but there's certainly less of it than there is here in the US, and I'm pretty optimistic about some of the changes that I'm seeing over there. We covered why I'm still bullish on international in our recent video about how, to many people's surprise, European banks have actually beaten the Magnificent Seven over the past 3 years. So, wait, what was that question again? How to avoid AI exposure and beat the S&P 500? Well, over the last 3 years, European banks did it. And if you told anyone that would happen 3 years ago, myself included, you would have been laughed right out of the room. And that happened while AI and the Mag 7 were doing great. 3 years ago was basically right at the launch of ChatGPT when tech stocks had been beaten up from the rising rate period and valuations were much more reasonable. Something besides tech doing well over the next 3 years, starting from where we are today, is honestly a much lower hurdle to clear. I've given you three options that I think could do it. But if you've got something that you're excited about or something that you're curious about, leave a comment below and let us know. Maybe we'll end up doing a deeper dive video about it like we did with this one. Then, if you found this video helpful, please be sure to subscribe and hit the like button on the way out so the video will get out to more people. More people will leave us comments with good ideas, and our next video will be even better. Thank you so much for watching, and we'll definitely look forward to seeing you in the next one.